What if I told you that if you miss just the best 50 trading days over a 40-year period investing in the stock markets, you could reduce your total investment returns by a staggering 95%. It's eye-watering, and it's not even an over-exaggeration. There are two big challenges with investing. The first is pulling the trigger and actually deciding to invest in the first place. The second is making sure you stay disciplined and don't let negative emotions keep you from staying invested, even when the going gets tough. This is How to Invest by Julius Baer, and in this episode we uncover the truth about long-term relationships. When you think of a buy and hold investor, that's someone whose strategy is to buy a product and hold it for a long time, usually 5 to 10 years, but it can be many more. You often think of Warren Buffett. He's the king of holding on to an investment. Asked how long he should hold something for, his answer is usually forever. And he has made his fortune using this strategy. But he's not the only one. Let me take you back to 1921 when Ronald Read was born. He's known now as a philanthropist and investor, but that wasn't until after his death in 2014. During his life, he was a janitor and petrol station attendant in the USA, and he lived a very frugal life. But he did make regular investments into company stocks over the course of his 92 years. And by the time of his death in 2014, he had investments totaling nearly $8 million, a huge surprise to his friends and family. And what do Read and Buffett both have in common? Apart from both making their fortune later in life, they both had the long-term view. Another famous investor, Bernard Baruch, who secured his fortune on the New York Stock Exchange, once said, "Buying at the bottom and selling at the top is typically done by liars." Harsh, but true. And while buying low and selling high might work on occasion, it's unusual, and more investors will have success following the likes of Read and Buffett. Historically, US stocks, US treasuries, nor the US 60-40 blend held over a 20-year period have had a negative return. You've got to be in it to win it, because the alternative is to time the market, and that isn't for the faint-hearted. Timing the market is doing exactly as investor Bernard Baruch suggests, buying at the bottom and selling at the top. And if you remember from episode 2, trying to do this is one of the biggest mistakes investors can make. Remember the old adage, time in the market is better than timing the market. Investors in general have a poor track record in timing the market. This is because the best days usually occur during periods of severe market stress. Think about the last 30 years. We've had COVID, the great financial crisis, 9/11, war, Brexit, and the dot-com bubble bursting. Lots of crises to worry about, but also many opportunities to sell off. But here's the thing. It's not the selling that's the worry, it's the buying back in. Knowing when the market has bottomed is the tricky bit. And it's then that you miss the best days of trading, resulting in catastrophic losses for your portfolio. Let's take a closer look. This is the total return and the value of $10,000 invested in the S&P 500 index from 1980 to 2018. If you miss the top 5 trading days, you lose 35% of potential returns. Miss the top 50 days, and you lose over 90% of your potential returns. Ouch. Staying invested pays off, but you have to ride the storms in between. So forget about market timing. It can be the most expensive exercise in the world. Rather, think of it this way. What you buy is more important than when you buy. But why else might holding onto a stock be a good strategy? Well, it has a little something to do with fundamentals. Fundamentals are the factors that drive asset values over the long run. Things like a company's financial health, growth prospects, and overall market trends, rather than short-term market noise. We'll speak more about overall market trends in our next episode on megatrends, but these are basically built-in trends that no matter what will drive change. This includes things like social, technological, and geopolitical factors. In the shorter term, market performance comes down to technical issues and animal spirit. Speaking of which, a man and a dog are walking together in a park. The man is heading to the other side of the park. The path he takes is not a straight line. Sometimes he turns a bit to the left or a bit to the right. He can even slightly change the speed of his walk and sometimes stops for a few minutes. But at the end of this walk, he reaches his destination, the other side of the park. The dog, meanwhile, runs everywhere, left and right and up and down and back and forth. The directions it takes are often erratic and random. The dog is almost never with the man as it runs here and there, although from time to time, it comes back close to him. At the end of his run, the dog is back with his owner, and they are both in the same place. If the man has walked for 2 kilometers, the dog has probably run for 15 kilometers. The man is the economy, the dog is the market. It is not possible to forecast where the dog will run next, just like timing the market is impossible. Only the long-term goal matters, where both man and dog reconnect at the end of the park. Now there's another lesson here about cash, but I'll save that for another day. The point of all our stories and analogies today is that you have to have investment discipline to maximize your investment returns. So to sum up, here are 5 do's and don'ts when investing for the long term. Do pay attention to how you feel, but don't react emotionally and take action while in a state of discomfort. Do notice the panic around you, but don't rely on talking heads or news headlines to make a decision. Do stick to your plan, but don't confuse the short term with the long term and try to time the market. And finally, try at least to have a sense of humor. What investment questions can we solve for you? Comment below. And next time, we look at the fundamental trends driving our economies and why it makes sense to future-proof your investments today. Make sure you don't miss it by clicking the like and subscribe button, and we'll see you next time.